Hi, my name is Farshad Maltes, and I'm the Director of Economic Development for WHEDA, the Wisconsin Housing and Economic Development Authority. And I'm going to be talking about some of the new exciting products that WHEDA is going to be rolling out to try to promote economic development in Wisconsin. One of those important products is our WHEDA's Loan Participation Program. And under this program, we will be able to participate up to 50% with financial institutions, but also with non-traditional financial institutions such as community development financial institutions, community development corporations, or economic development corporations, also with city or municipality revolving loan funds. So we are able to participate in more organizations than some other programs such as the SBA or the USDA program. So that's one unique feature about the WHEDA Participation Loan Program, is that we can participate with non-traditional financial institutions, but of course we can also participate with traditional banks as well. Another interesting feature about our participation program is that it is a subordinate participation, or it can potentially be a subordinate participation. What that means is that WHEDA can participate in a second position and take a subordinate position in terms of the collateral of the deal. So this way, that our participating partner, be it a bank or another non-traditional financial institution, can have first position on the mortgage and have a stronger loan-to-value position, since we are going to be taking a second position. So that's another, strong benefit or feature of the loan participation program. The other feature of the loan participation program, our loan participation program, is that it can also be used for takeout financing, that is permanent financing on a deal, but it can also be used for construction financing as well. So we'll talk a little bit about some of the unique ways that participation lending can also be used with other programs, such as the Small Business Administration 504 program. And I'd like to mention two ways that our participation loan program can be blended and complements the SBA 504 program. One way is that we can, on the construction note, we can take a subordinate position on the 40% that is behind the 50% in a first position, in a SBA 504 deal. So just to kind of recap very quickly how a SBA 504 deal works, under the SBA 504 program, the first position lender has a first position a loan that they do for 50% of that loan. So the first 50% of the loan is collateralized on a first position, and a traditional lender, SBA participant lender, does that deal. The next 40% of the financing for the deal is going to at least be in the permanent financing side, financed through an SBA debenture. That debenture or debenture bond will be subordinate to that first 50%. So that subordinate piece provides the next 40% of the financing for the deal. And then the final 10% of the deal is provided as equity by the borrower. That's why SBA 504 deals commonly are referred to as 50-40-10 deals. 50% first position mortgage to the senior lender, 40% is the SBA subordinate piece, and then the 10% is the equity that the borrower brings into the deal. Now, the problem sometimes for an SBA 504 deal is that SBA comes in for the permanent, or what they call the takeout financing for the deal. They will not participate or provide financing for the construction part of the deal. For this reason, the banks have to usually take 100% loan to value on the construction note. They have to provide a construction note where they're assuming all of the risk, and SBA is not providing any financing or assuming any risk. What WHEDA can do through its loan participation program is provide a subordinate participation for that 40% that the bank traditionally would have to do alone. That way, the bank doesn't have to do a 90% loan-to-value loan on the construction side. They stay at 50% loan-to-value throughout the total SBA 504 deal. And again, WHEDA feels that there are some deals that right now would be job-creating and have great positive community impacts that are not being done because the banks just simply do not feel comfortable for some of these SBA 504 deals doing the construction note that's necessary to even get the deal off the ground. And that's one way we hope that this program will be able to get more deals done and complement the SBA 504 program. The other way that the WHEDA Participation Loan Program could be used in a 504 deal is on that first 50%. WHEDA would be more than happy to participate and even participate in a subordinate position on that first 50%. So for example, the bank could decide to provide the first 20% of a SBA 504 deal, and we would then provide the next 30% in a subordinate position. So we are able to participate also on that first part of an SBA 504 note. Again, I do want to highlight the subordinate position that we can take through this participation. We think that this is really what makes the WHEDA Participation Loan Program unique and distinct. And again, we hope that it will be a tool that banks can use to still be able to do strong notes and strong loans that keep them in good stead with the regulators with strong loan to values, but also get loans done and projects financed that would not otherwise be financed without this source of gap or mezzanine, second position financing.